Lesson 9D, this is the fourth and final part of profitability and liquidity. As you can see, it's got 4 ticks, but these are 4 bite-sized chunks for this particular topic. Off we go, let's go look into the analysis of what we're doing. You can go and get the coffee on because we're on the final lap now. We're looking at using the ratios and the profit margin work that we've done. So this one is about understanding what you've done and why you've done it. So this one isn't number crunching, this one is doing the writing. So you can see the stepping stones we're going through. We're looking at knowing the ratios and profit margins, obviously being able to use them because that's what we've covered in parts 1, 2 and 3, but we're now on the skills lesson, sorry, the application lesson, the blue shape, the blue rectangle, to actually analyze what's happened once you've used them. So the key vocabulary for this lesson is liquidity and profitability, and an update on the job situation in finance. Here's your first analytical question on profitability and liquidity. Question 1. A business may be able to state that they have made a profit on a sale. However, this might not mean they currently have the cash from this profit. Explain why. So have a think about some of the calculations. Let's start with the first one we did in lesson 9A, gross profit margin. So let's go back a step and think about gross profit. In order to calculate gross profit, you needed to know revenue and cost of sales. So let's have a think. Just because you have made profit, which is in its general term, that tends to mean how much money you've got in, you haven't deducted any costs or expenses from it. So you're looking what's also known as revenue, that top figure. You've got all of that, and if you've got a high cost of sale, then when you calculate that as a profit margin, that's going to come crashing down. So you need to look at that in terms of percentage of the profit to see what is kept by the business to really determine whether they have cash. And cash, as we know, is called a current asset. Two questions from Lord Business. Question 2. What does it mean if a business is solvent? Solvent is the business's ability to meet its short-term debts when they are due. Debts is another word, liabilities. So when people say they want their bills paid, then the business needs to be able to pay it. So when we're looking at that, we're looking at its working capital. Now, we covered that in lesson 8 and 7 to go over it. That's the duck lesson and the genie lesson, and that's what we need to write about if it's solvent. That's question 2. Question 3, what does it mean if a business is insolvent, and what could happen to that business? Now, obviously, insolvency is the opposite of solvent. So if solvent is the ability to pay its debts, then insolvent means they've got no money to pay their debts. And if they've got no money to pay their debts, then how are they going to pay their suppliers? Or worse still, how are they going to pay their workers? This thing's going on at the moment. And if you can't pay your workers or your suppliers, can the business actually carry on trading? If they can't raise finance, they're stuck. So this is what happens when businesses become insolvent. They eventually stop. So you need to put that into your words for question 3. Question 4. Other than showing if a business is solvent, what could a monthly review of profit tell us about a business? Write your answer in the box below. So let's pause. Let's just think. We're on part 4 of lesson 9. We have covered 4 key things. We have covered gross profit margin. Using the GPM, a business can determine what percentage of a pound they make in revenue and what bit they keep, because obviously they're deducting cost of sales. If company 1 makes £1 million and GPM is 11%, then they only get 11% of each pound that they make. The rest is gone to the bills that they pay. Then there's net profit margin. This is when all expenses are paid. So you've deducted cost of sales, gross profit margin, and you've got that percentage figure. Now we're moving on to net profit margin. So this is the one which all things are paid. So this tells you how much has gone on costs in total, and it actually tells you how much is net profit, also known as operating profit. If this percentage is going down each month, this month will the month will then show you that there's been too much spent on costs. So net profit is also a good one to use. Now we're going to think about current ratio. This shows you the value of a business's assets compared to its liabilities. However, if a business is very thorough in their review, their monthly review, they're going to move on to the fourth one, liquidity capital ratio. Liquidity capital ratio. This is when a business has removed stock in their calculations. So if there's a huge downwards leap, that indicates there's too much money for the business that's actually tied up in stock. So you wouldn't do the liquidity capital ratio on its own. You'd actually need to have the current ratio calculated as well, so you can see what's going on. And also, when you've got those two ratios, you probably want to know what percentage of your profit is going towards cost. So then you'd need the gross profit and net profit margin. So can you see these are all basically tools in your financial pencil case in order to look at and examine whether your business is being successful or not. Question 5 from President Business. What is the key difference between cash and profit? So here's a few things to think about. Cash, as you know, is the money in your hand, but you can also call cash the one that sits in the bank as well. And cash is the asset which businesses choose to pay expenses, choose to buy machinery. So that's what cash is. Profit is actually, haven't you taken away your cost of sales? We call that gross profit. Haven't you taken away your expenses? Then you've got net profit. Then you make a decision whether you retain some of the profit in the business. Question 6 from Wildfire, the action figure. What 2 actions can allow an enterprise to increase its profitability? You write the answers in the first action box and in the second action box. So think about what we've covered so far in terms of, say, gross profit margin. What would you need to reduce to increase your gross profit? Have a think about that one. Second action. Well, here, if we need to perhaps delve over to the liquid capital ratio, isn't that when you work that one out, you can look at how much stock is that suggesting that you have too much of? And if you have too much stock, don't you need to reduce the amount of stock? Obviously, reducing the amount of stock quickly does have its challenges because you've got to run a sale. But if perhaps if the business has a high current ratio, say of 5, wouldn't that indicate there's too much money tied up in stock? So what action could they do in order to reduce that situation? Choice is yours. Question 7 from Unikitty. What does it mean if an enterprise has good liquidity? So let's have a bit of a think here, a little bit of help for you. Liquidity, liquid, okay, the runny stuff. There is a point to that comment. The ability to pay the debts, the ability to have cash, the ability that current assets that can be easily turned into cash in under 12 months. The way you can turn that money and flow it from an asset and flow it into cash, and then when you've got cash you can then pay your debts or liabilities. And those are the things you tend to find on the statement of financial position, which is also known as a balance sheet. So those are the kinds of things we need to think about when you look at good liquidity. We're looking at this business of flowing the money from the asset side in order to pay what's on the liability side. So liquidity is how quickly you can turn one from the other. So in your own words in that box, please. Question 8 from Bad Cop. What does it mean if an enterprise has bad liquidity? Hence bad cop. Well, if you think about what we've looked at in terms of assets and liabilities, we want to look at how liquid a company is, so it's the ability to turn assets into cash. Now there's two types of assets. If you remember, there's fixed term assets and there's current assets. Now one of those can be turned into cash quickly and one of them can't. So work out and remember which one can't. And if you can't move that into a current asset and ultimately cash, doesn't that mean that the cash isn't flowing well in this business? Yes, you're actually discussing cash flow, and the liquid capital ratio can help you look at just how much is tied up in cash, tied up in stock. And while stock is considered a current asset, it is actually quite a pain and quite cumbersome and quite long-winded in order to do the sale and actually run the sale in order to turn it into cash. So we've got an example. Current assets are twice the value of current liabilities. We've got a ratio of 2. And if the business has a low current ratio, which is below 1, then we've got a bit of a problem. And if we add in the liquid capital ratio, which then takes away the stock, and it's still below 1, then this is what we're talking about. We're talking about how much is tied up in assets. We're talking about the ability to pay debts, and we're talking about the ability to actually flow the cash through the business.